Welcome back to EDS. In this video, we're going to go over exactly how you can write your own options contracts, collect a premium, and generate consistent and reliable returns year on year. So first thing you want to do is open up your broker platform. I'm using Tasty Trade. You can use whatever you like. It will all be the same thing. So first thing you want to do is you want to get up a list of securities. So just pull up your watch list, pull up whatever it is that you look at. So we're just going to go with Tasty default. And what you want to do is you want to filter everything by high IVR. The reason why we filter everything by high IVR is because IVR is IV rank, and the higher the IV rank, the higher the IV of the asset relative of the underlying relative to itself over the past year. Now, the reason why that's important is because volatility is mean reverting. So we want to sell when it's high and play the contraction. And that's exactly what we're going to do. So we go down the list and we have a look. So anything with a forward slash at the beginning is a futures instrument. So we're not going to go over futures. We've got Bitcoin here, we've got ETH. We're not going to go over Bitcoin and ETH. We're mainly just going to look at equities and ETFs. We've got gold futures here. We've got GLD. GLD is looking nice right now with an IV rank of 71.3. However, we put a position on, or we had a look at GLD in the last video, so we're not going to go over that today. Instead, what we can do is we can have a look at SLV. SLV is looking pretty nice. It's got an IV rank of 63.8. Anything above 50 is high. Anything below 50 is low. That's a general way of looking at it. However, in recent market conditions, anything above 30 is acceptable. And anything below 20 is very low. So anything above 30, I'd be looking at. So we've got SLV here, which is silver. So let's just take a look at the chart for silver. We don't trade based on the chart. We don't trade based on price action or indicators or any of that stuff. But just for context, I suppose we can have a look at it. At the bottom here, we've got IV rank visually plotted on this graph here, and we can see that where it is right now, it's kind of above average-ish. We did have a little spike over here in April, but relatively speaking, it is on the higher side right now, which is what we like to see. So that's all good. Next thing you want to do is you want to just go over into the trade tab, and we want to pick our expiration dates, right? So we want to stay away from the weeklies because there's less liquidity on the weeklies, and just stick to the monthlies, which is the monthlies meaning the third expiration week of each month, the third Friday of each month. And that happens to be, the next one happens to be on September 20th, and then the one after that is October 18th. So when picking your days to expiration, you want to be as close to 45 days as possible. I personally wouldn't go anything, I wouldn't go anywhere below 35. Usually I don't go below 40. So here, 28, that's way below what we want. So we want to go to the next one, which is 56 days out, October 18th. So if we have a look here, this is now the options chain. Now, this orange line in the middle shows where price currently is. It's at 27.06, which is right in between 27 and 28 as shown here. We've got calls on the left side, puts on the right hand side. This orange bar here is your expected move for the 56-day period. So what we want to do is want to have a look at the liquidity. We want to have a look at the spread. So if you have a look at the money bid and asks here, we can see that everything is a penny wide or a couple pennies wide, and that's good. That means it's very liquid, and it's good to go, really. We don't want a situation where the spread is too wide, because the wider the spread is what you pay every time you get in and get out of the trade. So the smaller the spread, the less you pay. And this spread is pretty tight, so that's fine. Next thing we want to do is we need to decide, okay, so which strikes are we going to pick? Okay, so which strike? So what we do is we look at this column here, delta. Okay, this is a delta column. We want to pick anything between 16 and 20 deltas. So this is a 16 delta right here. So we can sell a contract here at the 32 strike 16 delta for call contract. Then we go over to the put side, and on the put side here, now this is a good example. On the put side, we can see here that there is no 16 delta. It goes from 12 to 22. So we have a decision to make. Do we go to 12? Do we go to 22? Or do we abandon the entire trade altogether? So in this instance, because IV rank is so high right now, I would personally move it closer to, I would personally open the sell a contract at the 22 delta. Um, Sorry, yeah, the 20. I was looking at the wrong one there. This is the delta here. We'd open a contract at 25 at the 25 strike with a delta of 22. And then to balance it out, I'd move the short call down to 31. So we've got a 21 delta there and a 22 delta there. Overall, we've got a net delta of 1.41, and that's perfectly fine and acceptable for us. So with this trade now, we have a 68% probability of profit. Okay, so what does this actually mean? So if we go back to the chart, so let's have a look at the chart here. We can see the price currently at 27.09. Down here at the bottom, in the bottom left corner, we've got our order, which is a short short put contract at 25 and a short call contract at 31. So if we just mark those on the chart, so for visual purposes, 25 and 31. Okay, so let's just mark that here, 25 and 31. There we go. Okay, so we can see here we've marked it on the chart, 25 and 31. So this order here, if we were to execute that order and get filled, what is happening? So price is currently at 27. We would want price to stay in between this range that we've now just created. This is the call contract up here. This is the put contract down there. And we want price to stay within this range. Okay. If price breaks out of this range by expiration, or at expiration, sorry, if the price is outside of this range, then we'd be looking at taking a loss. If it stays within this range, we'd be looking at making a profit. So what is the profit and what is the loss? So as we can see here, we can see that based on these two contracts, if we would sell both of these contracts, we would collect a credit of 83 cents per share. So that would work out to $83, right? So because each contract controls 100 shares of the underlying. So 0.83 times 100 is $83. So we would collect $83 up front. And then what is our risk? So our max loss is infinite, right? Because this is a naked position. Okay, naked position meaning that there's nothing actually covering it. So this would be a max loss of it'd have an unlimited max loss potential. Okay. Now, although it does say unlimited, you'd never actually take an unlimited max loss, because you'd manage the risk accordingly, which we'll go into much more detail, which I can show you how to get that information about, going into much more detail about that. Now, so what is this number here? Buying power efficiency. This is a very important number, 333.3. Okay, this is how much money is going to be required by your broker in order to put this trade on. Now, where has this number come from? 333 is basically the buying power required, is simply how much the broker expects you will need to cover the worst 5% of cases, okay? So that you don't end up getting margin called and whatever else. So we lock up $333 and we collect $83, okay? and we have a 68% chance of that working out, which is a high probability trade. Now, what we can do to increase our probabilities even higher is we don't need to wait to collect all $83. Okay. Let's say, for example, if we were to take profit at $41 or $40, which is near enough 50%, we would then have a probability of profit of 83%, which is considerably higher than the 68%. So by taking profits early, we can increase our win rate. This is a trade that anybody can place in their accounts, whether you've got a small account or a large account. It only requires $300 in buying power. So even with an account as small as $5,000, this would perfectly be fine, and it would fit your risk metrics. Now, speaking of position sizing, we have a position sizing template that you can use. So you simply put in your portfolio size. For example, you could put in the VIX level. Let's just say if it was 17 today, and it will tell you exactly how you need to structure your portfolio. Now, everybody can get access to this position sizing template, and I'll show you how to do that at the end of the video. But for right now, this is what an example position looks like. So you use everything that we discussed in this video, combine it with a position sizing template like this, and you simply do that over and over and over again and let the odds work out in your favor over time. So we do have some positions. I'm not going to actually place this position because I'm at about the limit in my portfolio. This is just a smaller portfolio that we're managing here. So let's just look at some positions. So as we can see here, everything really is hovering at around break even. That's because we've only just put these positions on 3 days ago. We've got 56 days left till expiration. We've got plenty of time for everything to work out. Theta decay is every day. Theta is working in our favor, decaying away the value of these contracts. Remember, we short these contracts, so we sell high and then buy back lower at a later date. So gold is working nice. So we've got AMD here, we've got CMG, gold, Intel, semiconductor, ETF. We've got United Airlines. As you can see here, we're using a nice, diverse selection of underlyings to trade with. Everything is working exactly as it should. Let's just take a look at GLD. Why not? Okay, cool. So with GLD, where are our strikes with GLD? So our short strike, this is an iron condor, which we covered in the last video. If you haven't watched that, I encourage you to go ahead and watch that. So with GLD, we've got our short strikes at 250 and 222. So if we just mark that on the chart, 250 and 222. About there, that'll do. So we can see here GLD is perfectly within the range. We can see IVR, sorry, is slowly starting to come down, which is perfect for us. Everything is working as it should, and that is pretty much what's happening with all of these positions currently. So if you do see any red in your portfolio, don't worry. Just make sure that your strikes haven't been breached, and you'll be fine. Just keep letting the position work for you. Keep letting Theta do what Theta needs to do. If your strikes are breached, then of course you would then need to manage risk. So how do we manage risk, and what do we do if your strikes are breached? So we're not going to go over that in this video. However, if you do want to learn more, and if you do want to get a copy of this position sizing template, then click the link in the description, or you can go to launchpass.com/EDS/premium, and you can sign up to join the EDS premium access. So what you would receive is you'd get access to our portfolio, and you'd see all the positions that we place. You'd get the notifications exactly on the day that we place them. so that you can basically copy our trades and emulate our trades and see what we do. Whilst you're emulating our trades, you will have access to the full course, which will go over everything that you need to know, and it will take you from novice to expert. You don't need to have any prior knowledge, and you can get all of the information in there. So you can learn and earn at the same time. There is obviously, it is a community, so you can speak with myself and other individuals who are all on this same path, doing the same thing every single day. And there's also a 100% money back guarantee. So once you study that full course, and if you follow our trades for 6 months and you haven't been profitable, then we'll work for you. We'll work with you for free, or you can request a full refund. So it's completely risk free. And right now, it's only £1 a month, right? £1 a month. The price of this will increase. Every 5 members that join, the price will increase. However, whatever price you get in at, that price is locked in. So if you get in at £1 and then the price increases, you're locked in at £1. The price will never increase for you as long as you don't cancel and then rejoin. So you are rewarded for getting in early. And we've just started this. That's why it's so cheap. So get in while you can, and get direct access to myself and the team. And that's about it, really. So if you have any questions, please do let me know in the comments. And I will see you in the Discord.